Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
Hello. We are coming up on a new year. 2025 is just around the corner as of the time we're recording this. When it's published, it probably will be the new year already. So, we wanted to talk about a few nuances and small changes to retirement plans and all of those kinds of things. So, just going through those in detail so that you are well aware of anything that you may need to adjust. There's a few things that are changing, mostly contribution limits. There's some small parts of like the Secure Act 2.0 that were being phased in. So there's some small things that are taking effect from that act coming up this year. So we're going to walk through some of those and make sure that you are in a good spot to utilize all your tax advantaged retirement accounts and do as much as you can into those.
Yes, sir.
Mm-hmm.
So max out tax advantage plans. That's kind of once you get into an attending role, ideally you're taking advantage of all of the available tax favorable retirement vehicles you can you can utilize. So depending on your employment status, like what type of entity you work for, you may have more retirement accounts available than others. If you're self-employed, the limits can be, um, you have more control, I guess, over how much you do up to the IRS set limits. Whereas if you're at an employer, you can only do a certain amount, and then it's up to the employer if they want to do the rest or allow you to do more. Um, but we'll go through some of those limits, what the new limits are for 2025, so you can try and max those out. So let's start with the basics, the 401ks and 403bs, because those
Yeah.
are probably most relevant to most people.
Oh, yeah.
Um,
Almost everyone has one of those, obviously. But with the 401k and the 403b as an employee, the important part to keep in mind is your employee like voluntary deferral limit. So that's the amount that you can choose to put into your 403b or your 401k. In 2024, that limit was $23,000, and the goal is to try to max that out, obviously. And then in 2025, coming up, that limit has been increased by $500. So not a big increase, but you can do up to 23,500. So if your salary is the same and you are just on the verge of making that $23,000 contribution, you may need to go in and tweak it a little bit just to make sure that you can get to that limit by the end of the year if that's your goal. There's
you know,
also, yeah, go ahead, Corey.
every year the IRS will look at inflation and they will adjust retirement contributions and really all of these numbers that we're going to go through. They'll adjust it for inflation based on the consumer price index in $500 increments. So if inflation wasn't enough to warrant at least a $500 increase, then the contribution limit will stay the same. With your 401k and 403b, though, I would probably expect annual increases because $500 out of 23,000 is a 2.2% increase. So for all the news you hear about inflation's come down. It's more or less back to normal, not quite at the Fed's 2% target, but we're pretty darn close there. So as long as we see 2% inflation every year, you're going to see at least a $500 increase on your 401k, 403b contribution limits every year moving
Mhm.
forward. Oftentimes it might be $1,000 increase in some years.
Yeah, I think the one time you may see an exception is if there's some sort of recession or something, like inflation tends to be little to none in a recessionary environment. So that might be like the only time that you don't see increases to that contribution limit. Some of it remains the same because it's just like there's a smaller contribution to begin with. So that percentage is a little bit higher to reach. So the age 50 plus catch up contribution in 2025 is still 7,500, which is the same. It's important to keep in mind that if you do have multiple employers or if you have multiple employers in the same calendar year, that $23,000 500 employee deferral limit, that's across all plans. So your employee amount that you can put in applies to all like 401ks, 403b, even like a TSP if you end up working for the VA or something like that. That applies across all of those plans. So make sure if you have multiple plans, you're not contributing more than 23,500 across all those plans. It's fixable if you do that. It's just a pain in the rear. So we want to do it right the first time and make sure we get as much in as possible without going over. If you work for the same employer for the entire year and you're contributing to just like one 403b or 401k account, it will automatically put a cap in there at the contribution limit for that year. So you don't have to worry about it as much. If you think it's going to be like 10.5% to get to that contribution maximum, it's okay to set it at 11% to make sure you get that full amount in. And then they just won't take any more out when you reach that $23,500.
They should cap it. I've run into some.
Have you really? Oh my gosh, I
Well,
literally never have.
it's so the ones that I run into that won't cut you off will often direct those dollars above the 23 or 23.5 now limit into an after tax bucket.
Yes, that I have seen.
Um, which if they allow you to convert those after-tax dollars to Roth, it's pretty fantastic. If they don't allow you to convert the after-tax dollars to Roth, it's kind of annoying because, I mean, it's cool. You're saving more for retirement in a tax sheltered, highly asset protected account, but you're not getting a tax deduction on the contributions, and you still have to pay taxes on all the income taxes on all the investment earnings when you withdraw the money. So it's not from a tax standpoint, not super attractive. Um, but more and more companies are allowing the quote unquote mega backdoor Roth, where you can make after tax deferrals on top of that standard limit and convert those additional dollars into the Roth bucket, either within the plan or externally to your Roth IRA. So something to look
Yep.
into if your employer allows after tax Roth conversions in the workplace retirement plan.
Yep. And usually that would be larger employers. Like I haven't seen a lot of small companies doing that. But I mean, bottom line, pay attention to what your retirement plan options are at work and make sure you understand how they work. If you have a 457B or a 401A, these plans are like they're not subject to the same limits. They don't overlap. So that 403B, 401K, TSP limit of 23,500 is separate. The 457B has its own $23,500 limit. So you could literally max out both plan. 401A is usually like a very specific like contribution percentage, just depending on how your employer has set it up, and is usually not voluntary. So that also doesn't count towards like that employee voluntary deferral limit. The other thing to keep in mind is that your employer's contributions do not count towards that $23,500 limit. So you can put that amount in, they can put in more, like quite a bit more, a lot more. So the grand total 401k, 403b contribution limit for 2025 is $70,000, which means you can put in that 23,500. Your employer can put in a bunch more, depending on how they have set up their contributions into your retirement plan.
And that limit is before the catch up limit. So again,
Yeah.
if
So if
you're
you're,
over age
mhm.
50 or 50 or older, you can do an additional 7,500 on top of your 23.5. And that 7,500 is in addition to that 70,000 standardized limit. And this is a new feature with Secure Act 2.0. But if you're between the ages of 60 and 63, very specific, you have a 4-year window, age 60 to 63, your catch-up contribution is actually allowed to be 150% of the regular catch-up contribution. So in 2025, 150% of 7,500 is $11,250. So if you're over age 50, you can do 7,500. If you're between 60 and 63 years old, you can actually do 11,250 on top of your standard 23,500. So the grand total between you and your employer, if you're in that early 60s window that can go into a 401k, is potentially $81,250. So pretty sizable chunk of change there if the employer allows it or
Yeah.
offers, I should say.
Yeah. And most employers don't put that much into your retirement plan. Like you come across them sometimes, but it's pretty unusual. It's kind of the exception, not the rule. The other way that you can potentially get that much into a retirement plan, though, is if you're self employed. You know, if you have your own business, if you are 1099 and doing lots of locums work and things like that, you can potentially contribute a great deal of money into your 401k if you set one up, into like a SEP IRA if you decide to go that route. But you have to be careful because how much you can contribute is based in part on how much you earn and how much your like net profit is, how much you pay yourself in wages if you're an S corp, and all of that gets really, really, really complicated. So take that into consideration when you're making decisions about how to structure your business. When you're working with an accountant or financial professional, ideally they can kind of help you figure out how much to pay yourself, how much to put in your retirement plan, how to like kind of max that out and do the most possible. But if you are self-employed, you can make both an employee and an employer contribution. So that's the important distinction. You can max out that employee contribution, and then you can also make some sort of profit sharing contribution or something like that up to that full IRS limit for a 401k. So if you're, you know, pre age 50, 70,000. If you're in your 50s, 77,500. If you're in that 60 to 63 range, 81,000 plus. So there's a great deal of money that you can get into things like a solo 401k if you're making quite a bit of money. You just have to have the earnings to justify it.
Then you could even layer another plan, like a cash balance plan on top of it and save a healthy six-figure sum pre-tax
Yep.
for retirement. But yeah, a lot of different nuances depending on circumstances. If you're self-employed and you have employees, it can make it a little more complicated as you're not just yourself that you're worrying about. There's rules for how much you have to put into employees' accounts, but that's another topic for another day. Um, Now for those math nerds out there, or people that are really into this stuff, so the 401k contribution limit, the grand total for employee, employer, et cetera, is always going to be 1/5 of the covered compensation limit. Now, the covered compensation limit is how the IRS determines how much salary employers have to take into consideration when doing their matching or profit sharing contributions. So for 2025, the covered compensation limit is $350,000. Again, always 5 times what the 401k grand total is. And so if you're an employee at a company or a hospital, you're getting a salary, and the company does a 3% safe harbor 401k contribution, meaning they'll contribute 3% of your salary to the plan. Well, if you're making $300,000, all right, you'll get a $9,000 safe harbor contribution. If you're making $5 million, they're not going to do 3% of that. They're not giving you, what would that be?
A lot of
30,000 times
money.
five. So 150,000. You're not getting 150,000 in profit sharing. They're going to do 3% of 350,000, which comes out to like what, 11,000 or something. So they cut it off at that covered compensation limit for all the matching calculations. So something to be mindful of when if you're well, one, if you're working and making a high salary, you're not going to get a match on all of your income. It's only up to that covered compensation limit. Also, if you're a business owner, you have employees, you're trying to structure your retirement plan to benefit yourself most favorably. Um, Keep that in mind. The max salary you really need to pay yourself to max out all your retirement plans is 350,000 next year. If you're paying yourself less than that in salary and taking the rest in profit distributions, K1s, whatever, that's fine. It just might change the formula a little bit for how much, that ratio of how much you give yourself versus your employees on the profit sharing contributions. But again, another conversation for another day. Just some little nuance to be mindful of. These matching contributions only go up to that covered compensation limit.
Yep. One other thing that changes a little bit each year is the salary level you need to earn in order to be considered a highly compensated employee. And this matters a little bit for testing for like 401k plans to make sure they're not only benefiting people who make a lot of money and things like that. But that number has increased this year to $160,000. So if you are earning 160,000 or more, you are considered a highly compensated employee. The reason that we're mentioning it here is because starting in 2026, if you are considered a highly compensated employee, those catch up contributions that you can make when you're older must be Roth. They cannot be pre tax. So when you're age 50 plus and making those catch up contributions, the IRS is now saying you no longer get additional tax deductions by making pre tax contributions. You must make Roth contributions if you want to do this, which I mean, it's not bad. It just means that you're not going to get a tax deduction now. You just get to take out that money tax free when you take it out in retirement.
I believe that was originally supposed to take effect in 2024, but they kicked the can down the road to 2026 because payroll companies were like, we're not ready to calculate that.
Not all
Yeah.
employers even offer a Roth
Yeah.
option in 401ks right now. So that's a fairly big hurdle, is just being able, like, for everyone that offers a 401k to set up a Roth option. And that's definitely still not the case. Maybe it's like 75%, do you think, Corey? Like,
I
of
have
plans
no
offer
idea.
Roth? Who
But if
knows?
your 401k doesn't offer a Roth contribution option, it probably means they haven't reviewed and updated the plan in a long time, which means it's
Hmm.
probably not compliant with the IRS regulations. So,
Yeah, I had a couple of
like,
surprising ones that didn't have Roth options until the last couple of years, like very large educational institutions. I'm thinking of one in particular that I won't not mention out loud, but it was just like 2 years ago, I think, that they finally introduced a Roth option. And you would think that an institution that large would have been doing it for a very long time, but
yeah, so
who knows?
assuming the company is staying on top of their restatement requirements with the IRS, they should have a Roth option available. The question is, with this provision over the next year, are they going to be able to sync the payroll system with the 401k plan to like automatically factor that catch up amount to be Roth?
Hmm.
Because it's going to be an
Yeah,
administrative nightmare if they have to manually do it.
absolutely. Yep. IRA contribution limits are remaining the same. So if you make Roth IRA, traditional IRA, or somehow use the backdoor Roth strategy, you can contribute up to $7,000 per person in 2025, up to 8,000 with that catch up if you are age 50 plus, which is the same as in 2024. So again, it's like a smaller dollar amount to begin with. So that inflation calculation means like we didn't quite hit the hurdle we needed to increase it a little bit.
Simple IRAs, some of you have those. That limit goes up to 16,500. So if you have a simple, you can do a little bit more. This year, I think
Mm-hmm.
it's 16,000 in 2024, so another $500 increase. The annual benefit limit for defined benefit plans increases from 275 to 280. So not too many people have those, but like if you do have a cash balance or other type of defined benefit plan, that's the max benefit that they can base their formulas on. So potentially, if you have one of those, you could potentially get a retirement plan that pays you 280,000 a year, or is designed to pay you that much in retirement. Now, I don't know of any retirement plans that were set up in recent times that are like those true old school pensions. They're where that's designed to pay you a lifetime income stream in retirement. Most people that set up these defined benefit or cash balance plans basically create it to where if it's a larger company, when the employee leaves, they can cash it out and just roll it to their IRA or their new employer's 401k. I mean, in theory, they could carry it into retirement and collect that annuity stream, but anyone who's self-employed or a business owner setting these up for themselves, it's more so just a tax deferral strategy. We can stuff a ton of money into these. Like if you're in your 60s, you can put like over 300,000 a year pre-tax into these defined benefit plans. Um, so it's a great way, especially on the tail end of your career, to save a bunch of money in taxes and put a ton away for retirement. And then when you are ready to call it quits, you close down the business, you just cancel the um, cash balance plan, or if you're self-employed, cancel it when you retire, roll the money to your IRA, and you can do whatever you want with it at that point.
Yeah. That number is also relevant for like large companies or I don't know, like cities and things like that still offer pensions. Like there's not a lot of people working for a city that maybe earn that amount of money, but but if you have a pension at work, like that's the most they can kind of base their calculation on at this point in time.
Maybe like the state university football coach is getting that much thrown into his retirement plan as a state
Yep.
employee.
Mm-hmm. Absolutely. Yep. The one other number that changes every year is how much of your income you pay Social Security taxes on. So, not exactly related to retirement plans, but sort of related to retirement planning. So, that limit this year is $176,100. So, after you pay your Social Security tax on $176,100, they no longer take that tax out of your pay. So, if you're a person who owns or earns 300,000 plus and you middle of the year somehow mysteriously get a little increase in your take home pay, that's why, because you maxed out that Social Security tax. You don't have to pay it for the rest of the year.
But be aware, in January, you start paying it again. So you're going to get a
Yes,
pay
you
cut.
do.
Why is my pay
Yep,
lower now? Because you're paying your
because it's
Social Security
January.
again.
Yep.
See, required minimum distributions. These are getting more complicated as time goes on, which is annoying for us, especially because we have to like do different versions for different people.
To pay
Um,
attention.
I know. If you're already taking RMDs, great. You're already locked into whatever system you're on. If you haven't reached retirement age yet, or RMD age yet, once you turn 73, you have to start taking required minimum distributions from all of your 401k, IRA type accounts. Now, if you're still actively employed at an employer, you do not have to take RMDs from your active employer's retirement plan. So I guess for those of you still working into your 70s, that's a cool little feature. The age goes up to age 75 in 2033. So for most of our listeners, as it stands now, you won't have to start taking required amounts out of your retirement plans until you're 75 years old. And who knows, by the time you actually get to that point, it might be an older age.
Hmm.
Now, a cool new provision with the Secure Act or 2.0 Secure Act, one of those, you don't have to take RMDs from Roth accounts. So that's another incentive to put more money into Roth type accounts is, you're not forced to withdraw money from them. You can take it as you wish in retirement and then, pass them on to your kids tax free, which is cool. Uh, but if you are getting close to RMD age, or if you've inherited an IRA, which we'll talk about in a second, make sure you take your RMDs. The penalties are pretty steep if you don't. You got to pay a 25% penalty on the RMD amount if you fail to take it by December 31st. Now, if you catch it in a timely manner, I assume before the tax deadline,
No, it's like within 2 years. I looked it up,
oh,
Corey. You
really? You have
get
two
two
years?
years.
All
Yeah,
right.
that's timely manner.
All right, so you got 2 years to catch yourself, but it's like a 25% per year. But
Yeah.
but but that penalty is reduced to 10% if you correct it quickly enough. So within 2 years, according to Rochelle's good research. Um,
Google. I mean,
yeah, I
maybe
didn't
don't
go
quote me
that
on it.
far on Google, but so yeah, still not ideal. Make sure you're taking your RMDs. And I mean, you can try and go through a process to request a waiver if and everything. But yeah, take your RMDs. If you are receiving an inherited IRA, so from someone who passed away, and you're not that person's spouse. So if you're a spouse and you inherit your deceased spouse's IRA, they just treat it like your own for RMD purposes. But if like you're inheriting your parents' IRA, for example, you now must, and your parent died after 2019, so 2020 and beyond, is the date of death. That IRA must be depleted, or I guess any retirement account, Roth IRA, 401k, et cetera, must be depleted within 10 years of date of death. So you no longer do the formula based on age for RMDs in this scenario. You just have to drain the account within a decade. Now, I've got some mixed messages and don't have the official answer. Maybe you have a better answer, Rochelle, but my understanding is you're supposed to take a little bit out every year and deplete it by year 10. I know for sure if that person was already taking RMDs, you have to continue those RMDs and deplete it by year 10. But I've heard some people suggest just to be safe, you should plan to take some money out every year. Um, Although I don't know if the IRS is going after people who are not taking them. As long as it's depleted by year 10, I think you're good. But
I think so too. If the person that passed away wasn't taking RMDs,
then you don't
that's
have to
my
take any.
understanding.
Yeah.
And as long as it's empty by year 10. Yeah.
So right now, to give you some insight into our world, we've got like 9 different RMD things we're dealing with. You've got people who retired years ago that had to start taking RMDs at age 70. We've got people who inherited IRAs before 2020 that are taking it based on a lifetime distribution formula. We have people who are now retiring, don't have to take them till age 73. And
Or
then,
72 also, right?
oh
Wasn't
yeah,
there
there
like
was a
this brief
72
window where it
and
was
then
72?
73. And then in 8 years, it'll be 75. And then if you inherited an IRA from a spouse, you're on one formula. If you inherited an IRA from someone who wasn't a spouse after 2020, then you got to deplete it within 10 years. So we have like a map with yarn drawing on different points and like tables to figure
Almost
out
like a
who's got
murder
to take
investigation.
what from each account. Yeah. So IRS, if you're listening, you're not doing us any favors. You're making our lives more complicated than they need to be. So let's simplify the RMDs, please.
Isn't that the truth? Just across the board, though.
Or just don't
Oof.
require them. Like, I don't know. Maybe make it all just one thing at death. The kids can't keep an IRA. It has to all go to a taxable account at that point. I don't know. Just think of something simpler for my sanity.
We like simple. We do. So with health savings accounts, that's another one where the limit has increased. So this year the limit is 4,300 per individual, 8,550 for a family. We talk about that in this context because you can potentially invest in that account and it could be a good idea to do it. So think about that. I think that is a more nuanced conversation to have at a different time, but you can contribute more this year. You can potentially keep it in that account and potentially invest it for later use.
Let's see, 529s. Reason we're chatting about this one, there's not really a limit. I mean, there is, but most of you will never hit it. For most plans, it's like upwards of
Yeah,
$500,000 is
it's
what,
so
yeah.
much.
But a new provision that was implemented recently within the last couple of years, after the 529 account has been in existence for at least 15 years, up to $35,000 can be rolled from the 529 into the beneficiary's Roth IRA, um, up to the annual max limit for the IRA each year. So right now you can do 7,000 to a Roth IRA. So it would take you 5 years under current limits to utilize that full 35,000. And there's no income limitation on this. So you're the logic behind this is all right, kid finishes college, has some leftover money in the 529 account, starts their first job, not making a ton of money, rather than using their meager earnings or savings account to fund their Roth IRA, they can pull the money from their 529 account to fund their Roth IRA. Now, even if your kid's making a ton of money, computer science whiz, gets a job at Google, making 250 grand a year starting out at age 22, which is well above the Roth IRA income threshold for a single individual. Um, so, they could still fund a Roth IRA directly. They don't have to mess around with the backdoor Roth business. They can just take it from their 529, throw it straight into a Roth IRA up to the annual limit. Every year. So that's a cool little perk for those of you that are potentially worried about over saving in your kids' 529s. You have a little bit of a buffer there uh, down the road.
Yep. One other thing that gets adjusted for inflation every year is the gift tax exemption limit. So it's the amount that you can gift to a person in a year without having to disclose it to the IRS. So this year or this coming year in 2025, it will be $19,000 per person. So if that's the case, if you have two parents that want to gift you money, it would be $19,000 for each of them. So $38,000 total. In the context of a 529 plan, this matters a little bit too, because you can actually front load up to 5 years of that gift tax exemption into a 529 plan and not have to worry about gift tax exclusions and things like that. So 5 years times that 19,000, $95,000 per person, $190,000 per couple that you could put into a 529 plan and not have to worry about gift tax reporting stuff. Actually, I
And
think you have to disclose it, but it doesn't count towards your lifetime exemption amount.
yeah, so if you give more than 19,000 to an individual, you're supposed to report it on your tax return. It's not going to cause any tax implications for you in that
Right
year.
now.
right
Yeah.
now. It just the excess amount goes against your lifetime gifting limit, which for a married couple is like close to 30 million now. So for most of you,
Federally, but at the state level, it
federally.
can be quite a bit lower.
Correct,
Lower. Yeah.
federally. And who know, and that federal number will change over time. You know, every time we get a new
Yes.
president, they like to change taxes and limits and things around. So could be less, could be more in the future, who knows. But right now, now is a favorable time to die for an inheritance standpoint. You can basically leave up to 30 million without having to worry about federal taxes if you're married. Um, but yeah, at the state level, there's a number of states, I think, I don't know, a dozen of them, give or take, that have state tax implications at death. And most of them are relatively small, like where Rachelle and I are in Oregon. If you're worth over a million when you die, then anything above a million is taxed at the state level. So could make gifting more appealing to some folks that live in those states to get more money out of their name now so that it reduces the tax implications at death for that inheritance.
Yep, absolutely. Okay, so we told you a bunch of numbers. How do you apply this to your financial plan? So I think for employees, the most important thing is that you hit your maximum contribution limits if you can. If you're an attending, hopefully you can do that. So that's 23,500 as a baseline that hopefully you can put into your 403B or 401k or TSP if that's the kind of plan that you have. If you are living in a two income household, especially as attendings, ideally you're both maxing out those plans and those employee contributions, even if one partner makes significantly less. And I will say that this is something that I come across a lot with planning where, we have a doctor partner who makes 400,000 and we have a non-doctor partner who makes 100,000. Even if you're making $100,000 and you need to set your contribution percentage at 24% to max it out, like as a household, you can well afford to do that generally. So do it, like make it happen. You're getting tax savings as a household, even if it's coming disproportionately from one paycheck. That's fine. So if you're over age 50 or in that age 60 to 63 range, ideally you can also include the catch up contributions and do a little bit more on a tax advantage basis, potentially on a Roth basis, depending on what year we're in. And then like starting in 2026, that's when that Roth basis will kick in. And then I think another thing, like always, not just for this coming year, but think about tax rates when you're deciding on those Roth versus pre tax contributions. Like if you're in a relatively low tax bracket, especially compared to where you think you'll be long term, let's try to do some more Roth savings if that makes sense for you. If you're in a really high tax bracket, it may make sense to lean more heavily on those pre tax contributions. And like we know what tax rates are going to be in 2025, 2026 and beyond, we don't. Like the tax rates that we have right now are officially expiring in 2025. And so there will likely be some legislation to change that or extend that or something like that. So it's kind of a little bit of a mystery in terms of what tax rates will look like in 2026 and beyond. Although we do know who's going to be in office and what the inclination will be, which is keeping taxes low.
Or extending the Tax Cuts and Jobs Act
Yeah.
from whatever year, 2017, I think.
Yep.
If you're self-employed, you have a little bit more control. You can do a lot more on the retirement savings side of things. So if you have the means to stuff a ton of money into those tax favorable retirement accounts, you could potentially, if you layer in multiple retirement plans, could have six figures of pre-tax savings each year going away for retirement for yourself. And any side hustle money could apply here too. So like if you're working for a practice or institution, but you do, locums on the side or med legal consulting on the side, if it's paid to you as if you're an independent contractor, you could take a portion of that money and put it into a self-employed retirement plan. Business owners, same things. It's probably worth brushing up on the Secure Act 2.0 rules. If you own a business, new 401k plans established after 2022, I believe, need to include an auto enrollment feature for eligible employees. So it's not if the employee wants to participate, they can. It's no, they have to opt out if they don't want to participate. They're automatically enrolled at a set contribution otherwise. Be aware of the new catch-up contribution limits for the different age brackets. And in 2026, make sure your payroll system allows for Roth catch-up contributions, because for any higher income earners, they're going to have to do it on a Roth basis unless the rules get changed before then.
Or that date just gets pushed out again because they're like, ooh,
It's a
people really can't
possibility.
do this. Yeah, exactly.
Hmm.
One thing to just keep in mind as we're kind of switching years, moving from one year to the next, make sure you review your beneficiaries periodically. Like sometimes we set it and forget it. We put it in there. Maybe we didn't even have kids at the time, or maybe we weren't even like we didn't have a partner. We weren't married, whatever it is. So just make sure you look over those at work, any IRA accounts you have set up, etc., and update those if needed. So maybe like New Year is a good time to be thinking about those things. And then in summary, like every year, things are going to change a little bit. So make sure you're paying attention to updated contribution limits and all of that kind of stuff. Be aware of rule changes as they like change and affect you potentially. And then if you have big questions, like make sure you're working with a financial advisor and or an accountant if you want to stay on top of things. Especially if you're doing more complicated things like backdoor Roth or trying to set up like a self-employed retirement plan, like those things can be pretty complicated. So just to make sure that you're utilizing them to the best of your ability, it can be helpful to work with a professional. And then keep listening to the podcast. We'll likely cover relevant changes as they occur, hopefully, probably, and then share with your friends and tell them all about how great Corey and Rochelle are and how they just have so many pearls of wisdom and they're missing out because they haven't listened yet. Bottom
There we
line.
go. 5-star ratings all around.
That's right. They may all be from Corey and Rochelle, but under different account names.
Right.
Just kidding.
We're setting up burner accounts just to give ourselves ratings and
Yeah. It's very
reviews.
important to us, obviously.
Yeah. Yeah, we do.
No, thank you all for listening.
Yeah.
Just
Yeah,
for
we
real.
appreciate it. We basically do zero marketing for this podcast. I think our company posts it on Twitter. When the
We
new
don't, there
episode
is no
goes
Twitter
out,
anymore. It's called
X,
X.
whatever. Yeah.
Ew.
Um, but yeah, so it's all word of mouth, and we appreciate you spreading the word. So we'll see you next time. Have a good one.
Happy New Year.